Hello and welcome to today's live webinar where we look at ASX investment opportunities in review. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. The technology that I'm using today is the Investor Signals member services. If you'd like to subscribe to it, we offer the technology for $1,320 for 12 months. And you can contact 1300 614 002 or visit our website to start your trial. I'm moving straight into a graph of the XJO. Now, the counter move that equities have been strong since the December sell-off. We're now retracing a little over 50% of that December move. And what I've got on here are two moving averages, a 50-day and a 10-day, just as a way of showing that whilst we think that the market's getting pretty close to an exhaustion level within this counter trend move, we haven't yet had sort of the rollover that would begin to accelerate the selling pressure. So it's still early days, and for that reason we continue to run some long exposure in the market. We've trimmed gains and trying to sit on a little bit of cash and tilting the portfolios a little more towards defensive names like healthcare as example. In today's recording, what we'd normally do at this stage of the sort of series with these opportunities in review is focus on the recent signals, but I might just leave that for clients to scroll through those at your own leisure. The bulk of them are sell signals at the moment, which is just reflective of that lower high formation in the market. But the idea, if you're looking at the technology for the first time, is to come into your watch list. Today we're going to go through all 100 companies, and I'll move through them fairly quickly. But in your own time, if you come down here to the recent ASX signals, click on the first symbol, and then that'll take you into the chart, and you can use these arrows to toggle through that list of recent signals, which that stores the last 7 days of algorithm signals on the ASX 200 shares. So toggle through those, make sure you've got the feature turned on there, show Leon's charts, and you'll see where my support or resistance is relative to whether it be a buy signal or a sell signal. So up on screen at the moment is a chart of the XJO. So my thinking is we're pretty close to resistance at the moment, but as far as really building up on the short side of the market, you probably want to wait until the price action at least crosses back down through this 10-day moving average, just as a indication that the rollover is beginning to occur. So I'll update you on the blog when we see that playing out. What I'm going to do now is click on the watch list, go in here, select the ASX 100. So this works. Today we can see that Bank of Queensland, Brambles are all off. So these columns are interactive. You can click it again, get the greatest percentage gainers to the top. Ansell reported earnings today, which came in line or slightly ahead of expectations. And then so on. So what we're going to do is start. The way the software works is the lists that you're working with, they stay in the order that you've arranged them. So in this case, we've got the percentage gains to the top. And what I might do is come across here and we'll get all the buy signals to the top. And then we'll start. So what we're going to do is be toggling through all the stocks under buy conditions, and then we're going to get to the stocks under sell conditions. So let's start with that. So Unibail Rodamco, this is the old Westfield business, came out with its earnings result last week. The stock trades on about almost a 7% dividend yield. They're rationalising their portfolio, selling regional centres and consolidating the portfolio down to owning the best shopping centres in the world as they combine their portfolio with Westfield's business. Coles Group. So the concern with Coles is that over the next 12 months, you'll probably see further commentary out of the company around increased capital spending as they refurbish stores. The stock's on about 5% dividend yield at the moment. Earnings growth probably likely to be fairly moderate. So we expect at best Coles to track sideways, but in a market that may come under pressure, these consumer staples will probably hold up and do all right. So it's an area where you can own them and sell covered calls. JB Hi-Fi surprised the market with 5% earnings growth. So keeping in mind that all these that we're looking at the moment are under buy conditions, you can see JB Hi-Fi trending a little bit higher, but the consensus there is that the market is short JB Hi-Fi. IFL, probably a recovery's underway. The stock's maybe a little bit oversold, but they've certainly got a number of legal issues hanging over the head of the company as a result of the banking inquiry. Woodside Petroleum, so this is still, energy's been the standout performer of the market, and it's hard to really sort of say where this recovery in energy prices or the rally in energy prices stops. Saudi Arabia is really trying hard to drive, as is Russia, trying to drive up the price of oil, and they're succeeding at the moment. Woodside's a beneficiary of that, but I think when you tie in the view on the market that we're probably within, a few percentage points of the market running into resistance, I'd have to say that even these energy names are starting to look a little bit expensive. BlueScope, so not really part of our core portfolio at the moment, and we're a little bit cautious there on BlueScope. Evolution, so these gold mines that have done well. Our preference at the moment is Oceana over Evolution and Newcrest, but Evolution. So if you see on the blog a reference to a stock being under algorithm buy conditions or algorithm sell conditions, the green markers are the algorithm engine, not the red and green arrows. So given that the most recent signal in Evolution is the algorithm buy signal, that's a reference to being under buy conditions. If the most recent signal was a red marker up the top there, that would be a reference to it being under sell conditions. So Evolution still sits in the ASX 100 model portfolio, and for the time being it's continuing to trend higher, but I do think they're looking a bit expensive, Evolution and Newcrest. Reliance Worldwide, support there at around 420. You can see the moving average is trending higher, but again, not really part of our core portfolio, but it is in the model, ASX model, so the algorithm model. But obviously in client portfolios, we can't match the client portfolio in all cases to all the stocks in the model. For example, in the ASX 100, there might be 40 to 70 stocks in that portfolio at any point in time. CSL came in maybe a little bit below market consensus, but still delivering sort of that 10% earnings growth. So I think that remains a buy right at these levels. Woolworths, trading on a very high valuation, pushing up towards 22, 24 times earnings, 3.5% yield. We're expecting good earnings growth, but at that valuation, it's starting to look a little bit stretched. We'd like to be a buyer of that on a dip, but we'll wait and see what the upcoming earnings result looks like. I think they're in Cube. QBE Insurance, so this is one that we've been buying. So again, what we're looking at here is all the stocks out of the 100 that are in the model portfolio at the moment. So QBE, at around sort of 11.35, I think sell covered calls or take profit. Dexus, I think these real estate investment trusts are starting to look a little expensive, but you can see here the stock rallied from that recent signal back in October. Wesfarmers, similar story there to I guess to the retail space in general. The concerns are that Wesfarmers may, we started to see the early signs of a more flatter earnings trend in the recent result with Wesfarmers. What's a bit unknown is what is Wesfarmers, flatter earnings trend in the Bunnings business, which is the main component of Wesfarmers. Now, what's unknown to the market is the corporate strategy of Wesfarmers. There's been speculation that they might be looking for assets in the healthcare space. They may make acquisitions sort of within the chemicals industry, whether that's Incitec or, we'll wait and see. But at 5% dividend yield and a moderate, sort of 15 times PE with relatively flat earnings growth in Bunnings, to me, Wesfarmers is about sort of fair value where it is at the moment. TPG not doing there at the moment, although it's in the model. Northern Star under buy condition, so you can see the long history here of the algo signals doing well. The stock continues to make higher highs and higher lows. Macquarie is under buy condition, so it formed the low there at 100, now pushing up to 124. They reaffirmed 15% earnings growth. HealthScope is in the model. We continue to like this, albeit the takeover value that's on the table and recommended by the HealthScope shareholders to accept is at $2.50 a share. So that sort of caps the upside unless there's a competitive bid that comes forward. Crown reports its earnings, I think, next week. We'll have a look at those dates shortly. But Crown and Star Entertainment both look like they're good value. I think they're oversold. And the last earnings results, if you go back 6 months, there were strong numbers out of VIP gaming, and it's hard to see them falling off as much as the market's priced in over the last 6 months. So Crown we like. GPT, we've seen upgrade to their earnings. The company's delivering about 3 to 4% growth. The market like commentary out of the company where they're going to look to build an increasing pipeline of development acquisitions within sort of these large scale fulfillment centres, which is similar to Goodman Group's strategy, and that's helped to sort of drive GPT a little bit higher in the short term. But with that stock trading on less than a 5% yield, I think it's time to sell covered calls or take profit. ASX, so compelling business, defensive in the current market, but is looking a little bit expensive. REA Group, so not really part of our core strategy on client accounts, but this one does sit in the model and it was last added back into the model at around $69 there. Charter Hall Real Estate Investment Trust, it's in the model portfolio, making higher highs, higher lows. It was originally added into the model there at $5. ResMed, this is again in the model portfolio. You may recall that ResMed had a slight miss in earnings, and that was only relative to very high expectations that the market had. The stock trades on, or used to trade at this point in time here, going back a month or so ago, at 30 times earnings. It's a relatively low dividend yield, and at 30 times earnings, it was priced for perfection. The correction, we still think the longer term story for ResMed's very attractive. It's had sort of the bounce from these oversold conditions. We would look to buy it again on any pullback back towards $13. So add that one to your watch list. Australia and ANZ Bank's the only bank out of the four majors and the regionals that are actually in the model portfolio. But as we're seeing across the board with the banks, they are struggling to grow top-line revenue at the moment. Incitec Pivot, obviously this company's been impacted by the floods in North Queensland, which I think creates a buying opportunity. So we're yet to see how it really impacts their earnings and ultimately what the cleanup and return to normal business time frame is. But I think if you think about it over the next sort of 3 to 6 months, this is a buying opportunity for Incitec. I think you get an opportunity to pick it up at discounted prices. So maybe make a note there that somewhere between $3.20 and $3 is the buy range there on Incitec. Goodman, so this is an example of that property trust that has exposure to the faster growing fulfillment centers for online distribution. So if you think about kind of these facilities that Amazon would own for fulfilling orders and distributing them, Goodman Group partners with retail companies to build those facilities for them and rent them to them. And it's a high growth business model globally. And what we might start to see is that strategy drive above average growth out of GPT as well. Now, Goodman Group by a wide margin trades on the highest PE multiple, and that's just reflective of that better growth profile. But this rally that we've seen in these REITs has been a function of global interest rates. You might remember at the end of last year, the expectation was US was going to raise rates 4 times this year. Well, that's really been taken out of the market. So when interest rates have fallen, you've seen these yield-sensitive names being REITs and utilities do well. But the most part of that, I think, is played out for the moment. Scentre Group, I think lower growth real estate investment trust. This is the older Westfield Australia business, but on a higher dividend yield. You're getting paid 5.5% to hold this. The company's doing a share buyback, so owning it and selling covered calls makes sense there. Flight Centre, maybe there's some risks around retail spending here with travel, but the stock already has corrected a long way, so we'll wait to see. I think they report their earnings this week. So this is a fairly heavy week coming up for retail or discretionary spending earnings results. So it'll be something that we focus on as they come through on the blog. Vicinity Property Trust, lower growth, slightly missed on their recent earnings, and you can see sort of more of a flatter pattern there in Vicinity. Seek, look, I think this is one that you could add to your watch list. Now, if we think about a backdrop in the market where it may sort of run into some resistance, if you could actually pick Seek up at even, let's say sub $16, I think it would be very good buying. So maybe just keep that one on your watch list as well. Aurora, this is the spin-off of Amcor packaging business, a little expensive. It's under algorithm buy conditions. Look, thinking that we have support there at around $3. It's in the model portfolio, but not something we're active in client accounts. Now, Ansell's been a stock that's been in the high conviction list, and the earnings result today slightly exceeded market consensus. I don't think the stock goes too much higher than where it is at the moment. I think it bumps along sideways, but well supported by what looks like good earnings trends. So now we've shifted. So again, just to recap what we did, so we came into the watch list, we organized it by buy or sell. So the difference being we can click and get the sells to the top. We got the buys to the top. As we've toggled through the charts, it's moved through each one of these names until it's got down to the sell. And this is where we are at the moment, which is Ansell. So I'm just pointing out the separation. We've toggled through all the stocks that are in the ASX 100 model that are under buy conditions. Now we're going to look at all the stocks that are under sell. That doesn't mean that all of these are short opportunities. They simply mean that that we've taken profit on them and they're no longer in the model portfolio. So Ansell's an example of that. A2 Milk, so I think A2 Milk just looks expensive from a PE standpoint. Rio, so the resource stocks have rallied probably 10% beyond what we're expecting. So this breakout that we've had has been a little bit of a surprise. We're thinking that the market, in line with the index, runs into resistance and these resource names start to roll over a little. An area that we have been overweight has been these energy names, and it's only been in sort of a more recently that we've seen the sell signals in the energy names. But we've been long Origin, Santos, Woodside's actually still in the model, and interestingly, just to point that out, Woodside's I think the only energy stock that's actually left in the model portfolios at the moment. So Oil Search running in a resistance there at around 8.30. Ramsay Healthcare under sell conditions, but back on our radar simply because the prospect of the market moving into a risk-off phase should be good for Ramsay Healthcare. And you're getting a 3 and a bit% dividend yield, so it's one to think about as a defensive area to hide should volatility pick up in the market. Origin reports its earnings on Thursday, looking for this to move sort of up to around this $8 level. And the thinking here is that Santos's income that they earned from their LNG assets came in above expectations, and we think that same story plays out for Origin. We'd be selling into that earnings strength though. Santos back up against resistance. I think we're getting pretty close to an area that you can think about taking profit. So Whitehaven Coal rolled over. It's under sell conditions. That's been removed from the model. I put a post on the blog today about that. Alumina, again, very early stages. Okay, if we look at these moving averages and say, well, until such time as the price breaks back down through this 10-day average, we're going to sort of realize that the momentum's still carrying to the upside, but we are getting increasingly cautious of these short signals or these sell signals actually turning into true shorting opportunities. So to give you an idea, and if you follow the algorithm signals, you've probably picked this up. Whereas historically we've held maybe between 60 to 70% of an index, so let's say the ASX 100, there would normally be 60 to 70 stocks in the model portfolio, meaning under buy conditions. At the moment, that's now dropped well below 50%, so it's reflective of sort of the momentum of the market for the most part actually starting to deteriorate a little. So BHP under sell signal at the moment. So one of the ways that you can think about sort of stocks that you don't want to get rid of is actually selling in the money calls. So coming down below the current price, selling a European call option, getting access to the upcoming dividend and protecting some of the downside. So part of our premium account brokerage service is where I work in partnership with you to help manage those positions on your portfolio, place the orders, set up the derivative strategy. So if you'd like to know more about the premium broking account, please email me, leon@investorsignals.com. Oz Minerals, so we're taking profit on that today. Magellan, a little bit cautious there, just with a backdrop of the global market. Iluka, see that eventually kind of rolling over under that sell condition. Fortescue's been a very strong breakout to the upside, but thinking that that's starting to run into resistance there. Lendlease, this is an interesting story. It's under sell conditions. There's a price gap in it back up to, say, $17. Now, the interesting part with Lendlease is they've obviously had this issue with the engineering business with the cost overrun on, I think it's the North Connects tunnel in Sydney. I'd expect that the upcoming profit announcement that the company will be very clear on what their strategy is with that engineering business. It should be received as a positive if the company makes an indication that they're spinning that division off or looking at a trade sale, and that the stock could re-rate back up to sort of $15, $16 off the back of that announcement. Newcrest, again, starting to think that some of these gold plays, our preference is Oceana Gold over Newcrest. James Hardie, so the building stocks have had a reasonable recovery with the exception of Boral. And again, I'd maybe urge you just to add Boral onto your watch list. I think if you're willing to take a longer term view, and there's some risks as to whether the housing market deteriorates further over the next 6, 12, 18 months, and that's a global issue. But for the most part, a lot of bad news is already priced into Boral. You've seen James Hardie and CSR have some level of recovery. I think James Hardie could sort of push up into that sort of $18 to $19 range there and then run into resistance. Now, this was one of the high conviction ideas we spoke about going back at the beginning of these recordings for this series of the value in some of these housing and construction companies because they'd been oversold. So hopefully you've picked up some of the profit potential there. Link Administration, I didn't think this earnings result was as good as what it needed to be, so a bit cautious there on Link. Stockland, so again, all these stocks that we're moving through at the moment are the ones that are under sell conditions. So Stockland's making lower low, lower highs, resistance there. So all these are not in the model portfolio at present. Dulux Group, so had a recovery from oversold, but back under sell conditions there. South 32, the resources have been strong, momentum still positive, so you wouldn't be sort of rushing to be sitting on the short side of any of these until they come back down through that shorter term average there. Star Entertainment, now this is under sell conditions, but like the story with Crown, I think the VIP gaming revenue is better than the market's expecting. I think they've priced in the worst, and the upcoming earnings result on Thursday could surprise to the upside. You could think about buying call options as a way of containing risk there, where you're getting the upside and you're limiting your downside. Challenger, not doing there at the moment. Medibank Private, so the earnings result came out. Underlying growth, if you strip out investments, was running at about 2%, which is pretty consistent with our view that we've maintained. Here we said that the stock was oversold at $2.30 and it was a buy anywhere from $2.50 to this $3 levels back to fair value, and I think it tracks sideways, so either take profit or sell call options over it. Worley, I just point out that I do read that a number of analysts are pretty bullish here on Worley Parsons. There's a price gap in the stock back up to $17. Momentum's still positive, so whether you sort of carried that, my preference is try to obviously only buy stocks under buy conditions, but you could think about this stock from the context that if you were staying long it, as long as it stays above that shorter term moving average, but if it turns back down, I'd be a little bit cautious. Telstra, so the earnings result really, I think, met market expectations. There was some relief that the dividend on a forecast basis is going to remain around 16 cents, which puts a stock on about a 5.8% dividend yield. I think it just bumps alongside sideways for the time being. CYB under sell conditions. There's a price gap in this back down to around 325, and I think there's an opportunity to buy. I actually quite like the earnings result here. I thought the beginning of better margins coming through from the loan book from the acquisition of Virgin Money should sort of set CYB up for something sort of more interesting throughout the course of this year, but it is under sell conditions. So it's just a matter of developing that strategy in your plan as to whether you're only going to buy the stocks in the first part of this presentation, which were all stocks under buy conditions, and just recognize that whilst there's opportunities within these sell conditions, you kind of, for the most part, you're sort of fighting the trend of the market. Caltex, it's had a counter trend rally here back up to around $28. I think that's fair value. So again, either take profit or sell covered calls. Spark Infrastructure, not doing there at the moment. APA, not really part of our focus. Sydney Airports, I think it's interesting the rally that this had from 630 back up to 690, back up at fair value at the moment. So again, either take profit or sell covered calls. AGL, full value where it is at the moment. So either take value, or take profit, or sell covered calls. Mirvac Group, look, I think that's looking a bit expensive, and this might be one that you just keep an eye on as it starts to break back down through that shorter term average. I think that's one that there are risks to the downside in. Coca-Cola, what I'm waiting for here is another sort of slight rollover and a retest. Anything sub $8, I'd be a buyer of Coca-Cola just on valuation grounds. Zero, not doing there at the moment. There's the index. Car sales. So the earnings result fell short. The stock's still on a reasonable dividend yield, about 4.5%. The stock's bounced back fairly quickly. So for the moment, we'd expect this to go into a period of consolidation. So we're not really strong. We were buyers of car sales there at $11 expressed on the blog. We spoke about taking profit up above $12. Sort of at the moment, we're just watching and see how the market starts to digest those latest earnings results. Aristocrat Leisure. So this has had a strong counter trend bounce here from $20 back up to $25. Again, this was one that we had on our high conviction list as a buy between $20 and $21. We've now taken profit on it. I think the stock, again, watch this one closely, because if we get the rollover in the market and a bit of risk off, then I think Aristocrat could come under pressure, even though it's a favourite among fund managers and they've been strong buyers of the stock. It will be one that I'll keep a close eye on and comment on the blog. Boral, so this is a counter trend move here from an oversold position, and we'll focus on the upcoming earnings result for Boral. But I think it could be reasonable value starting to emerge, and most of the bad news priced into Boral there. Orica, not doing there at the moment. Sonic Healthcare reports its earnings. I'll have a look closer at that date, but they're within a few days or a week of reporting their results. I think the stock's now full value, so either take profit or sell covered calls over Sonic. Qantas, I think probably the primary trend here is that it's actually deteriorating a little. I think there's some sort of bigger structural issues around the capital spending requirements for Qantas over the next number of years, obviously higher oil prices. So it's hard to see the environment that Qantas actually does better, albeit maybe one argument is the lower Aussie dollar encourages, inbound tourism. We've seen that reflected in the data from Sydney airports, where actually inbound flights from the US statistically or in percentage terms are up relative to most other arriving destinations. So Horizon, we like this. We were buyers of it earlier, or late last year, I should say, at around this $4 level. We've either sold covered calls or capped out the gains. I think keep an eye on this. I think it rolls over from where I think the recovery's now done. I think it rolls over. But if we see it back down at around 425, I think it's a buy. I can see Horizon sort of starting a multi-year recovery from where it is at the moment on valuation grounds, and the issues that they had with the government and agreeing on price rises for rail haulage. It appears that for the most part those type of issues are behind the company. So if we see a sort of higher low formation around 425, I'd be a buyer of that. CBA, banks all under lower lows, lower highs. If we look at the history here of these algo signals, no surprise there that CBA is putting in another lower high formation, as is Westpac. So lower low, lower high there. Amcor, so this was a high conviction idea that had been expressed on these recordings coming into the earnings results. We're buyers of it down here at around $13. At around $14.50 to $14.70, we've been taking profit. If we look at the earnings result, the actual underlying earnings growth in Amcor was fairly moderate. The real story is they finalised the Bemis acquisition in the June quarter. There's about $180 million of cost savings that they'll strip out of the company over the next couple of years. But otherwise, the growth in the business for the moment seems fairly flat. So I'd have to think that we're close to resistance in this recovery in Amcor. But it is an attractive defensive business. So even in a weak market, Amcor should hold up better on a relative basis. Transurban running in a resistance just on valuation grounds. I don't see it sort of doing too much more than where it is at the moment. Domino Pizzas, I think this company has some structural issues, trading on a high PE valuation and fighting obviously the changes in consumer behaviour with easy access to delivery food. So to me, competition's increasing, and it's hard to see sort of Domino's positioning, which once was a technology edge, being sort of maintained. So I think structurally over a period of time, doesn't hold sort of the PE multiple that it has in the past. NAB, lower low, lower highs across, as we've seen with all the banks, as with Bendigo. Earnings, I think Bendigo and Bank of Queensland, BOQ in particular, their earnings slipped about 9%. Bendigo just started to see a deterioration in revenue. The profit was really kind of, maybe fudged is not the right word. The profit was supported by add backs of pre-provisioned bad loans, and that story starts to have a limited lifespan. So I think the market's been justifiably sort of negative on these regional banks. CIMIC Group up against resistance now. So again, this was one of the high conviction ideas. We were bullish on this from sort of 42, but between sort of 48 and $50, I think that's full value. If we get a rollover in the market like we're expecting, an opportunity to buy on the dip, this is a high quality business that delivers growth over the next 5 years. ALS not doing there at the moment, nor in Adelaide Brighton. Again, all these under algorithm sell conditions, so we can see AMP back there still trending lower for the moment. Suncorp, recent sell signal. This is one that we put on the blog. Lower low, lower high. Just point out here on Suncorp, there's a price gap back up to 13.41. Whether we reverse and fill that, we'll wait and see. But the issues here for Suncorp, I think, is the insurance margins are known, and maybe there's some risk of deterioration in their banking side of their business. So Insurance Australia Group, the underlying business was actually growing at a very healthy rate, and that drove the re-rate. So at first the market was concerned the earnings were a miss, but after working through one-off items, the underlying insurance business actually grew at double digits, and we saw the stock jump from $7 up to $7.70. Maybe it just settles back around this $7.50 level, which is fair value, but it's a high quality insurance business, and I'd be pretty comfortable being a buyer of this again on anything sort of back down near that $7 level there. Cleanaway, so this was on our high conviction list. The earnings result really exceeded expectation. The company delivered, I think, around 15% underlying earnings growth, and we've taken profit on that now. Downer EDI, we've taken profit on this. So this was a high conviction idea. We've taken profit of somewhere between sort of $7 and $7.50 roughly. High quality business like CIMIC. So if we see this roll over and we can buy it at $6.50 again in the coming months or weeks, that gets onto our radar. Not doing there in Atlas. Computershare, whilst the earnings result did better than I think some people were fearing, including myself, the company delivered 12% earnings growth. I thought the result was a little bit lumpy in some of its contributing factors that may not be repeatable. So I'm still bearish on Computershare, especially now that it's switched under algorithm sell signals. I think on a 1 to 3 year outlook, I just don't see the company maintaining the valuation that it trades on at the moment. Cochlear, not doing there at present. Treasury, look, I thought the earnings result was good, but the market had high expectations, so it's under sell conditions, but I think it holds up okay. Tabcorp, maybe the market was expecting too much out of Tabcorp. At $4.50, I think it's back on support. Buying it, let's say we do get a bit of selling pickup later this week. I think if you could pick up Tabcorp, anything back around this $4.30 level looks good value to me. Brambles, this is one that we're a bit cautious on, so we've been taking profit on Brambles. Again, not that the result was bad, but the company's unlikely to deliver profit growth, so we're only a buyer of it back down at sort of this $10 level. Bank of Queensland, so lower lows, lower highs. We can see the rollover there. And then there we are back to Unibail. So a couple of things just to finish with today's recording. I'll just bring into screen the earnings calendar, and then we'll look at the notes for today's presentation. So if we just recap, so this is the last of the recordings for the next few weeks in the Opportunities in Review series. So next week I'll publish an ASX Top 50 full strategy review, and then we'll have a break for a few weeks and pick things up again towards the middle or end of March. But if we recap where we're at with earnings, so James Hardie's forecast was a little bit better than the market expected, and that's been reflected in the price doing well. CBA was a little bit weak. CYB was a little bit better, and I think make a note. If you can buy it at $3.20, it looks good value to me. Insurance Australia Group, make a note. If that pulls back to $7.20, that's a buy. It was a good quality result. AGL, we don't particularly like. I think that's take profit. Downer, I think make a note on that. If you could buy that sub $6.50 on any broader market sell-off, it's a high-quality business. Amcor, I think the story there is take profit. I'll update you on the blog when we're ready to buy that again. AZJ, same thing. I think that's a buy, but I'll update you on the blog when months away. But $4.20, I'm a buyer of that again. Bendigo, all the banks sort of struggling. GPT, I've spoken about that in depth. So if we look at the earnings result, Amcor, did better than the market was fearing. AZJ did better. Bendigo did worse. GPT, it's that upgrade story around them moving into those fulfillment centres. Macquarie delivered 15% earnings growth. Transurban disappointed a little. Car disappointed. Computershare we just covered. CSL came in line, I think. Tabcorp maybe fell short of high expectations. ASX, I think that was in line. Suncorp maybe disappointed a little. Telstra was in line. Treasury had high expectations. Link maybe disappointed a little. Medibank, I think, in line. Origin, not sure that was right there. So I think Origin might be this week. So we can see there the earnings on Thursday. Ansell did better than expected today. Brambles maybe fell short. So tomorrow we got BHP, but a bit cautious. I think full value there in BHP. Oil Search full value. Sonic, I think full value. Woolworths a little bit cautious on. What else have we got here? So Iris, I think that could be a potential. Add that to your watch list. I think that could be a little bit weak. Tame Thursday. That's one of the key ones that I'm interested in looking at. So I'll just move that out of screen and we'll bring the notes in. So when we send out the replay of today's recording, under the replay button, you'll see a link to these notes. So what we generally try to do is under the general notes section is we shift those ideas up to the high conviction just as a point of focus from the recording. So if we look back at our general notes, so we liked Ansell, we liked Simic, we liked Woolworths, but recognize we liked Woodside, we liked Oil Search, we liked Origin, we liked IAG. Seek never really did much. Sonic has rallied from sort of 21 up to 24 almost. QBE we liked, which that's rallied. Suncorp we liked, but that's rolled over and no longer. Magellan, I've put a question mark there because you probably don't want to be short that until the index rolls over. But so these growth at a reasonable price. We liked Aristocrat, Treasury, Car, Flight Centre and Seek are the two that really didn't move. But all those names I think are mostly sort of a little bit expensive now, maybe with the exception of Seek and Flight, which Seek I'm probably back at $16. That'd be worth having a look at. The recovery underway in Unibail Rodemco, I think that's a multi-year story. The building names we like, the one that hasn't yet moved is Boral. I've just highlighted that's under sell conditions and they've downgraded earnings, so it's going to be slower going, but I still think that there's an opportunity there. So if we come up to where we are today, I think so if the market starts to soften, where do you want to be? Arguably there's still a few cents left in HealthScope, but it's marginal, so you're really buying that, hoping that there's a last minute competitive bid. I think Star Entertainment, as I've discussed, I think Crown Resorts, I think CSL is a buy right in a soft market is a good place to store money and deliver cash flow. Boral we've covered. OGC, Oceana Gold, that's more of a technical trade off the algorithm. It looks like a recovery is underway in Ramsay Healthcare and a buy right over Ansell. These are the ones that were there from prior weeks. So again, if we go through them, we've ticked most of these off. Origin, Amcor, the insurance names, I think that story's done now. ResMed, we're buyers of that at 13. It hit 14. I wouldn't be a buyer around at 13. Cleanaway, that rallied from 180 to 220, so I think that story's done. So now we start to focus on the shorts that we had, which were Bendigo and Qantas. Qantas has moved a little bit lower, but clearly Bendigo and Bank of Queensland have rolled over substantially. The XJOs start to keep a close eye on sort of as it starts to break down and the impact that that'll have on the short signals in the market. I hope you've benefited from this series of opportunities in review. If you've got any questions, don't hesitate to call the office, 1300 614 002. And if you want to set up the technology, visit the website or give me a call. And I look forward to chatting again mid-March. Thank you.